So I don't know if it's just me, but it seems like there is a pretty clear trend online pushing a particular narrative, specifically about AI being in a current bubble. Come on, just take a look at some of these headlines. So Jeff Bezos agrees with OpenAI Sam Altman. We are in an AI bubble. And coming out from Bloomberg, why fears of a $1 trillion AI bubble are growing. And the headline that took the champion title without a shadow of a doubt. The AI bubble is 17 times the size of the dot-com frenzy and 4 times the subprime bubble, analyst says. So regardless of how you spin the words, one thing is for sure that it's not in a bubble, which is the YouTube like button. It can never grow bigger than the number of views on this channel, so I do appreciate it if you help take the time to like it. But anywho anyhow, do you know who is the most excited about this prevailing bubble narrative? Those that are not invested in the markets. Because like any bubble, if you allow it to run its course, it will reach a peak moment and then down when the bubble pops. And that is when investors with a lot of cash on the sidelines can take advantage of this opportunity. So as you can see, there is this constant tension between those that are heavily invested versus those that are constantly sitting on the sidelines waiting for that big crash. And now, not only in the mainstream media, the creator economy are also warning you beforehand. They're extremely kind, telling you things like, the AI bubble is about to burst. Is the AI bubble finally bursting? The AI bubble is bursting. The AI bubble is about to burst. And we can go on and on about it. The AI bubble is bursting. AI investors are getting nervous. 5 stocks and 5 reasons I'll avoid this AI bubble. And the AI bubble now, worse than the dot-com bubble. Here's why. And yes, I'm part of this creator economy, and I just wanted to drop a kind reminder to understand what is the incentive system and structure here. Now, you can say that the media is fear-mongering. You can say that content creators are out there just to create clickbait titles and to get the number of views. How about Goldman Sachs? They are one of the top investment banks out there with huge assets under management. Clearly and surely, they are much more trustworthy. And the Goldman CEO, Mr. David Solomon, said that, I wouldn't be surprised if in the next 12 to 24 months, we see a drawdown with respect to equity markets. How do you feel right now? Feel free to leave in the comments below. And so not only that, you have to look at this entire media apparatus or machinery as self-reinforcing. And once a particular narrative hits the mainstream, you start to see it self-reinforce in very magical and fanciful ways. So Poems by Phillip Capital is letting you pick your rewards to match your investment style. So if you prefer higher potential returns, choose growth stocks. And if you want steadier performance, choose stable stocks. And Poems is now offering welcome rewards of up to 1,000 Singapore dollars to help you start with investing. And to claim the first tier of gifts, open a Poems account with the link down below and opt in to Smart Pub at sign up. Fund 3,000 Singapore dollars within the first 14 days of account opening, keep it there for 30 days, and make at least 3 eligible buy trades to receive 50 Singapore dollars worth of fractional shares. So you can then choose between a growth stock like Nvidia or a stable stock like Amazon for your fractional shares payout. And if you want more, fund more than 10,000 Singapore dollars and make 5 eligible buy trades to receive $150 in fractional shares instead. And then pick between 2 groups, Palantir and Nvidia for growth or Microsoft and Amazon for stability. So sign up as a new user to Poems, fund your account, trade, and as a reward, choose the stocks that fit your goal. So full details and the T&Cs are in the description below. Thanks to Poems for sponsoring this video. So I've recently just came across this tweet on x.com and it garnered quite a bit of number of views. And it started off with, this is alarming, triple dot. So almost 40% of the US real GDP growth last quarter was driven by tech capital expenditure. And the bulk of the capex was AI related investments. So aggregate capex can't keep climbing like this in the absence of real profits derived from these AI investments. So if this doesn't happen soon enough, we'll likely see some substantial slowdown in GDP growth, which can trigger a deep correction in the market, given that the valuations are already at elevated levels. So I think it's time to be more fearful than greedy. So I think from time to time, we tend to get hit by some of these different developments of part of the economy. I'm looking at macro indicators. I'm looking at, for example, even AI capital expenditure. So I'm not saying that these postings are bad per se. The nature of it isn't bad. It gives you more viewpoints, different perspectives to consider your base case, and really understand where the markets are currently sitting at. In fact, I'll be the first to admit, I'll be even more fearful if I scroll through social media and all they're telling me is how good the economy is going to be, how great the stock market would boom, it will 2-3x in the next 5 to 10 years. And we have to always balance between the bull and bear cases, and the truth is oftentimes somewhere in between. Now, here's the thing. As a retail investor myself, as I consume such content, and even for those of you across the globe through this screen listening to me, we tend to only want one thing after consuming such content. What is the next step going from here? So I'm not too sure if you saw that meme before, but there is this error 404, instructions unclear, and then they tell you that, oh, I'm going to sell, I'm going to buy more stock. But the truth is, just basing our investment decision from this one piece of content itself might prove to be pretty premature. And amidst this bubble talk, I think this is one of the best responses that I've seen, which is from Professor Damodaran himself. I'll play a short clip.
I don't like using that word because it comes with a sense of arrogance. Bubble basically says, I'm the smart one, I'm the rational one. Look at these crazy, shallow people pushing prices up. Are US stocks richly priced? Absolutely, by every metric. Price earnings ratios, just looking at the level of the index. But I'm not willing to draw that jump and say, okay, it's a bubble, because bubble essentially means there's a correction coming. And here's why I think we've got to give the equity market some slack. First, if you look at US company earnings, not just in the last year, but over the last 15 years, it's remarkable how US company earnings have become far more resilient. It's almost like companies have learned to keep earnings going in the midst of crises, in the midst of changes around them. Barring that COVID correction, which was understandable, the entire economy shut down. And even then, think of how quickly earnings came back. So the first force that's driving the market is that earnings have continued to grow this year, in spite of all the negative talk, in spite of all the tariff talk. And 75% of US companies have beat earnings expectations this year. So as analysts have expected lower earnings, they've beaten the expectations.
And to add, especially amongst this kind of bubblish, extremely euphoric part of the market, sometimes some things are often pretty underestimated. Specifically, when comparing to the tech valuations today versus 1999, before the dot-com crash in the 2000s, the 1999 median PE was around 41 times, and the current median PE is at roughly 31 times. Subtly hint to investors that there is still maybe potentially a 30% upside before the bubble gets fully formed, like compared to the dot-com. And one of the most upvoted or liked comment from that particular content was that table shows that the so-called bubble crowd is right. But it also shows, as most probably already know, that it can grow much larger. So that's the thing again, you see. Error 404. Instruction is unclear. So, unlike other content being put out there, instead of just trying to pull out 690 different data points to prove whether the case for the AI bubble exists or not, so I don't want to shove a particular narrative down your throat. And yes, some of you might look up to what I think about the current market landscape, and I'm extremely appreciative of that. But instead, I think I wanted to roleplay God in inverted commas. I want to bring you back to a blog that was posted back in 2019 from Mr. Nick himself, that is the Chief Operating Officer of Ritholtz Wealth Management. So the title is pretty intriguing. He said that, or he argued that even God couldn't beat dollar cost averaging. So the argument here is pretty simple. So imagine that you dropped somewhere in history between the 1920 to the 1979, and you have to invest in the US market for the next 40 years. And you have two choices. Firstly, you either dollar cost average and invest $100 per month for all 40 years, or secondly, you buy the dip. Meaning to say, you save $100 per month and only buy when the market is in a dip, and it's defined as any time when the market is not at an all-time high. So why until 1979? Because you have to be vested in a rolling 40-year period, and from 2019 you deduct by 40 years. 1979 is the last benchmark cumulative 40-year period. Here's the very interesting thing. To make the deal even sweeter, we'll make you omniscient, basically like God, telling you exactly when is the lowest point to buy. You'll know exactly when the market is at on the absolute bottom between any two all-time high periods. So you get to exploit that kind of rate of compounding and to also basically sit out on any of these so-called lost decade periods. So this will ensure that when you buy the dip, it is always at the lowest possible price. So before we review the answer, given these two different options, which strategy do you choose? DCA or you buy the dip? given that you have the hindsight bias. So of course, clearly, as the author has argued, given the title of the blog post, the DCA actually worked out even better. So if you run this strategy, you actually see that the buy the dip strategy underperforms DCA over 70% of the time. And why is this so? Because buying the dip only works when you know that a severe decline is coming and you can time it perfectly. Since big dips haven't happened too often in the US market history, distinctly in that time period, it's in the 1930s, the 1970s, and the 2000s dot-com crash. And more importantly, an additional factor here is that missing the bottom by just 2 months actually lowers the chance of outperforming the DCA strategy from 30% to 3% only. Just let that sink in. So you can see that this diagram is basically the trailing returns of the S&P 500 until 2019, and the green dots are basically denoting the all-time high periods of the S&P 500. And now, assuming that you employed the buy the dip strategy, and the red dots are precisely the lowest point you can buy between the two all-time high periods. And to put it into perspective, this is the buy the dip strategy. You are basically just buying all the way until the 2000, where you experienced that so-called lost decade. You accumulated all your funds in between and deployed it one shot during this red dot period, and then you just continue accumulating cash and then buy again during the red dot period. But I think there are a few nuances here that you have to take note of, which is, I think buy the dip works incredibly well when the big dips happen in the earlier part of the journey, so the compounding can work in your favor. However, I think on average, they don't work as well as people might have expected. But starting in 1975, you can see that the buy the dip strategy actually underperformed severely. And it is because it missed the bottom that occurred in 1974, the previous year, and the next all-time high actually doesn't occur until 1985, meaning to say there was no dip to buy until then. So what's the general takeaway from this experiment? I think first and foremost, clearly, trying to time the bottom is incredibly hard. And we are working with close to near impossible matrix and conditions for you to be able to see in hindsight, this is clearly the bottom. And it's not a game that I wish to play in. So when evaluating the performances, I think you need to really understand the context. If you're not managing funds for others and you're not an investment manager of any sort, your contribution tends to follow a certain pattern, whether it's on a monthly, quarterly, or yearly basis, via a fixed monthly salary or the business profit payout cycle through dividends or just profit sharing. So you're not a closed-end fund, so there will always be this cash drag component here, regardless of how you move your funds around or to maximize the high-yield savings account. If you're trying to convert all or most of your holdings today into cash, assuming that you are already a very big investor, for that logic to play out and for you to come out on top, meaning to say that you are making essentially a bet that within the next few years, we must see one of the biggest crashes of financial history, rivaling the dot-com bubble, and hence the comparison between the tech dot-com boom versus the today's AI bubble. In order for you to justify the potential upside-downside risk here, assuming that you miss out the entire bull run, and just sit on the sidelines with cash. So my job here is really just more trying to give you a framework to think through the different decision-making tree. It's a very timely recent Peter Lynch reminder, is that far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So for myself, I think clearly the DCA, dollar cost averaging, continues. And I've extracted my past transactions and buy into the VOO, which tracks the S&P 500. It's a monthly affair. And as you can see, there are, I guess, half-yearly sell orders because I do convert the VOO into a broad-based world index. So then, some of you might be curious about what am I personally doing. So other than that DCA that I've shown you, that will not stop. The train will never stop. But on the side, I think other than the ETF portion, I do have a large part of my portfolio that I manage actively because I am a DIY or an active investor, whatever you want to categorize me under. I am personally trying to semi-shore up cash on the side, albeit at a very slow pace. And here's why. I think for those of you that know me for quite some time, I've always been a huge proponent of staying vested in the markets for the long term and not to try to jump in and out, unless it's your own trading portfolio with different objectives. And I put 2 asterisk sign there is also that I think the big context of this discussion here is I don't know you. I'm only sharing what I'm doing here. And Hopefully, I don't look that old. I personally do have a very, very long time horizon. All things considered, I always try to stay mostly vested in the market rather than hold a very big, sizable cash position of 20, 30, or even 40%. So please don't just see what I'm doing and superimpose everything to yourself and your own journey. Everybody have different risk objectives, time horizon, and things like that. So please go and find a trusted advisor to talk things through. But personally, for myself, I've always found it hard to keep big cash amounts at the side because I really fundamentally believe that regardless of the general market conditions, bubble, no bubble, recession, no recession, there will always be opportunities if you keep looking, even this time period included, when everybody is saying that AI is in a bubble. So I believe that the cash component of the portfolio should always be dynamic, and it can be adjusted based on how comfortable the investor is. So there is really no quote-unquote right answer. But the majority, for myself, in my view, should still be vested. So whether should the cash position be 10%, 15%, or even 20%, I'll leave it up to you to decide. But back to my point, being a huge proponent of staying vested in the markets, I naturally don't have a huge cash position or cash sizing since the start of my entire investment journey. So in this case, I think my cash has always been under 5% for the longest time ever because I keep deploying. And yes, for those of you who know, especially in my own portfolio allocation, companies like Meituan, Lululemon continues to be the disappointing child, hence getting a lot of attention from me. And I think till date, year to date, they are one of the largest positions that I've added to because of their abysmal performance, considering that we are in an all-time high, a monstrous rally for both the US and Chinese market. But I think why the recent change or difference in attitude of wanting to hold more cash? Well, there's no particular reason, but I do like to use a lot of anecdotal reasoning. And this time do feel like there is some sort of a flashback to back in 2020, 2021. I'm not going to explain too much, but I do believe that the current AI narrative and payoff will be extremely huge in the long term. But some of these different names and exposure and excitement tends to get a little bit overboard, and I do like to feel a little bit on the safer side. So by building my cash position, I'm not trying to actively sell my existing exposure, but just deploying a little bit slower and potentially doing some rebalancing on my existing portfolio. Nothing aggressive or nothing game-changing. So this is my own game plan, so feel free to think through the experiment that we talked about, and feel free to leave in the comments below on what you think of this entire AI bubble narrative. And with that in mind, I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.